the Efficient Building Fund serving municipal sector, you've taken what I think is a fairly innovative structure for pooling together multiple municipal projects with a pretty broad RFP that, as we heard, was wildly successful and brought in more than you have the capacity to handle at this point, which I think is a really good thing. How did Rhode Island think through all the ways it might go about financing municipal building projects, and how did you arrive on this exact structure as opposed to any of the other myriad kind of strategies that we've already heard discussed from the panel?
Well, I guess a couple things. One, we're still working through that structure.
Okay.
And we hope to get that done in the next week or two, because we do have some deadlines, and I think that was one of the challenges that the program had is very ambitious time frame for its first round. Really, the bank was new mission came about at the end of last fall, trying to move this forward. New program, nobody really understands it. You got a lot of work to do to move it forward. One of the things we did do is we took some ERA funds we had that weren't eligible to capitalize or support financing, but we could use elsewhere. And we decided that we were going to pay for the energy audits, kickstart this program. You don't have to worry about that. We'll pay for it, get it done, and that put a lot together. The other thing was we had two very key deadlines, which is the end of June, one of which, of course, was just the beginning of the traditional school construction period. Schools shut down, that's when they do all the work. So if you're trying to do energy efficiency, renewables in schools, you got to really get everything in place by the end of June when school's out and they do it over the summertime. The other is that we had an exception to the ability of the communities to issue GO debt without a vote by the end of June. And that's a hard date going forward. Now some communities would still perhaps like the political cover of having their constituents vote on that. But that's one of the things two of the things that we were fighting: schools and the vote for the GO debt. And so it was really a very compressed period of time. And so I think we're very encouraged by the fact that despite that compression of time and the fact that we did kickstart a lot of this, is that we've got a significant amount of interest in looking to move it forward. Having a limited amount of funds contributed us to capitalize this has also been challenging. That's one of the things we're working through, of how do we use a variety of capital that's available to us, whether it's the capital on the balance sheet of the bank, which has been part of the way we run our business, some of the RIIB funds, the QECB allocation. The state has provided us with all of its QECB allocation. That's a positive thing, which enables us to help reduce the cost of finance to the communities. One of the other biggest challenges we have here as well is this is debt. Even though these, as you heard, the average savings on these is over 30% savings in energy. That's a real cash flow. These are cash flow positive transactions, whether it's 5-year street lights, it's 10-year, 15-year projects that we're looking at. We're looking at a variety of those. We've got a natural tranching almost in 5, 10, and 15 years, which helps the structuring of a transaction quite well, because we can parcel out some of that risk. That's, I think, part of the value that the bank brings to the table is we obviously have a slightly different risk perspective than private sources of capital. We are willing to take some of that longer term risk if the market isn't, and we're willing to take it at a rate that still makes sense. And so we have that ability to parcel it out. But we still have the constraint at the municipality level that this is debt. It's GO debt. Even though it's budget positive, it pays for itself over time. We're still not sure how the rating agencies will treat that. And frankly, that's a challenge I put forth to this crowd is, Doug Peterson, who's the CEO of S&P, was the co-chair of the Bipartisan Policy Commission on Infrastructure. They just put out the report. I don't know if you've seen it. It came out last week. It's about 115 pages about how the U.S. can meet this significant infrastructure need. So here you have the co-chairman of this committee, who is the CEO of one of the biggest rating agencies. And I think that's one of the things we need to challenge the rating agencies is how are they going to treat this debt that is self-paying over time at the municipal level. And it is important. It is important environmentally. It's important for the economy. It's important to jobs. And it's very good for the communities and the schools because it does pay it back. I mean, those are some of the things that we're wrestling with as we kick off this program and look to get everything done within the next 5 weeks. You know, it will not be a revolving fund structure like we did before, but we are engaging with private sector lenders to look to lend into this effective pooling. We will still pool the loans, and because we do think that there's value that the bank has in terms of being an intermediary. We've never had a default. We've never, you know, with the communities, we've never had a delinquency. People like to pay us back. We also structure it in a way that if somebody isn't paying or isn't delinquent, everybody else has to pay more. That cooperative structure. And we think that that is very valuable as well from a lender's point of view, and that people should be a little bit more aggressive in viewing us as an intermediary. And frankly, somebody who also has capital to help support those transactions.
And Jeff, in our prep call, you mentioned another really crucial challenge that green banks have, or really an opportunity, is coordinating with other existing state entities and state programs and utility programs, especially in efficiency, where I think each of your states has an incredible array of programs and support functions already in place. So how do you think about the infrastructure bank fitting into that? And I'm interested to hear this from each of you, because I know all of your states have pretty unique challenges in this space.
Yeah, that was something I didn't mention. One of the challenges we had with schools was these are very important projects. We could provide finance at a lower rate than they could obtain in the market. Yet the Department of Education had a somewhat competing product that they could rebate both some principal and interest if they borrowed from the Department of Education, its sister lending organization. That was a real problem because frankly they don't have enough money to meet all the demands of the schools for safety, soundness, basic infrastructure, and energy efficiency and renewables. Yet many of the school districts were sitting back saying, well, you know, if I go into that program, I'll get some of my money back. It'll ultimately be a lot cheaper. Yet there isn't enough money to go around. So we had some school districts who were much more forward-thinking, thinking, well, you know what, I'm going to use Department of Education funds to fund my safety and soundness, and I'll use the infrastructure bank's funds to fund my energy efficiency and renewables. That way I get more, frankly, in terms of upgrading the schools. Under the leadership of Treasurer Magaziner, we were able to get together with the Office of Energy Resources, Department of Education, the Infrastructure Bank, Treasurer's Office, to come up with a solution to that of how do we really eliminate that issue. And I'll say it's frankly probably one of the best meetings I've ever been in. Even in the private sector, we had 20 plus people around the table, and we had a 22-minute meeting and came to an agreement. You know, how that happened, I don't know, but it's like I said, it was the best meeting I think I've ever been in my 30-plus career. Everybody was on the same page coming into the meeting. We had an agreement as to how we're going to move this forward, how we're going to split the responsibilities, the funding, and how we are also going to use that capacity of funds that were there to, again, even lower the cost even more and enable the infrastructure bank's loans and energy efficiency and renewables to participate in that program. And so we really came forward with came out of that meeting with a plan and agreement as to how we are going to properly partner to make sure that our schools were getting the most funding possible and also able to participate in the energy efficiency and renewable program that we were funding.
Yeah, Mary, I'm interested in your views on this.
Yeah, so when we were first being formed, we set up stakeholder groups, which included all of the different players in the market. And we were really committed to addressing gaps in the market. We didn't want to create a program that somebody else had. We didn't want to replicate other revolving loan programs that were out there. And that's what we continue to do. One of the things that our legislation in 2008 created was an energy optimization collaboration through the Michigan Public Service Commission. And so all of the stakeholders, the utilities, the Michigan Public Service Commission, the Michigan Agency for Energy, us, other nonprofits, participate in this energy optimization collaboration. And so it gives us that forum and that structure to have conversations like what Jeff was talking about, like where are the gaps in the marketplace, what's already existing, so that we don't have to create something that's already working in the marketplace. And that's worked really, really well, along with all of the people that are on our board. They are very committed to making sure that we know what's going on. We're very tied into the Michigan Agency for Energy, so if they're creating a revolving loan program or something like that, we have a conversation about what are the markets that they're serving, what are the markets that we're serving, just for that whole purpose of addressing those gaps and also leveraging that leveraging the private capital, making the most use of that public capital that we have from the beginning.
So Alfred, you sit within the organization that runs a lot of these programs. How does that relationship work? What does that conversation look like between you and NYSERDA?
Well, that's right. NYSERDA runs quite a few programs, and I'll use Resi Solar as an example, or any solar deployment. So in New York, we have New York Sun, which is a demand creation support, where there are amounts that are paid to developers over time to deploy solar. That's all about creating demand and making the solution economic from end user's perspective. Where you have demand, there's also often the need for financing, and that's where the green bank comes in. So if you have a lot of demand but you can't get the financing, you have a problem. We're here to overcome the financing barriers. So we certainly communicate on where we see activity. We're very fortunate to be part of a great state policy and great leadership that's driving a lot of demand in the state, because that means there's more need for green bank capital to support financing solutions. But we really just track it. It's not a problem if someone is getting a New York Sun incentive and getting New York Green Bank financing. That's fine. But we do track that information because we want to be able to provide that information to all our stakeholders over time in terms of how much state-related support is involved in getting these transactions up and running.
Bryan, how about you?
Yeah, so I think big picture from policy to practice. So from a public policy perspective, it's actually legislated. The relationship between the Connecticut Energy Efficiency Fund and the Connecticut Green Bank. Through a joint committee, we're required to develop joint programming around financing. That's the policy picture. But in practice, so we really operate under a Connecticut umbrella called Energize Connecticut. So we're trying to present to the customer, I would assume kind of Michigan Saves is that kind of campaigny thing too as well, which is to try to communicate to the customer, here's the portal upon which you can go to find incentives, technical support, financing, et cetera. In terms of this joint committee and the interactions that we have with our utilities, which is great, we've got Eversource and Avangrid, we've got 5 working groups where we've established joint goals in our respective conservation and load management plan and our comprehensive plan. So we've got a single family working group, a multifamily working group, public sector, small business, and medium and large business sectors. So our teams are working very closely now to develop goals and working to align incentives and financing programs, because the more we can utilize incentives to drive more deeper measures, the more MMBTUs, kilowatt hours, all those things that we can produce. And all of that, of course, translates into more investment in your economy, which creates jobs and reduces greenhouse gas emissions. So we do it from a policy perspective, and then we practice it through a governance structure.